This is Niranjan Reddy, Assistant Professor, BITS Varangal. Today we will see leverage and different types of leverage and calculation of leverage and total risk, how it will affect the market price of share of a company. So first of all, leverage is the employment of an asset or source of finance for which firm pays fixed cost or fixed return. So we have these three types of leverage: operating leverage, financial leverage, and combined leverage. Operating leverage is defined as the ability of a firm to use fixed operating cost to magnify the effects of changes in sales on changes in EBIT. It can also be calculated by the formula contribution divided by EBIT. So this value is always greater than 1. Then financial leverage. It is defined as the ability of a firm to use financial fixed financial cost to magnify the effects of changes in EBIT to on changes in EPS, and it can be calculated by this formula: EBIT divided by EBIT minus interest. So this value will always be greater than 1. Combined leverage. So it is the product of DOL and DFL. So we'll see one financial plan. So for which how the operating leverage, financial leverage, and combined leverage is calculated. So this is the method of calculating leverage. So this is the formula. So here sales revenue, variable cost, contribution, fixed cost, EBIT. So here interest is deducted from EBIT, so that we'll get EBT. When tax is deducted from EBT, we'll get earnings after tax. So when it is divided by number of shares, we'll get EPS. So this anyhow from previous chapters. So financial plans. So the funds is raised by equity capital, debt. Number 1, equity capital. Number 2, debt. Number 3, preferential shares, and other methods. It may be combination of 1 and 2, 2 and 3, combination of 1, 2 and 3. So we'll see one financial plan in which, so here different financial plans are there. So in one plan, so our sales revenue is 2 lakhs, and this is the variable cost, and this is deducted from this one. So we got contribution 1 lakh, and when fixed cost, so here this 50,000 is fixed cost, and this is deducted from this one. So we got EBIT, and interest is deducted from EBIT, so we got EBT. So we got this value 35,000. So from the formulas of DOL and DFL, we got these values. Degree of operating leverage is 2, degree of financial leverage is 1.428, and combined leverage we got this value 2.857. So this is how we will calculate leverage degree of operating leverage, degree of financial leverage, and combined leverage. When the leverage value is less, uh, the value of total risk will be less, so that the market price of shares of a company is more likely to go up. So this is how it is useful. So this is brief about leverage. PAT value is more than fixed rate of return, it is favorable leverage. When the EBIT value is less than fixed rate of return or fixed return, it is unfavorable leverage. The total risk is the risk associated with the combined leverage. So this is the graphical method of EBIT and EPS analysis. EBIT in lakhs, so this is on x-axis, EPS on y-axis, this is in rupees. So we have taken two financial plans, two financial plans. So this is the indifference point or indifference line. So it is defined as the level of EBIT for which EPS value is same for both the financial plans 1 and 2. So this region is equity advantage and this region is debt advantage. So this point is break even point. So this is the graphical representation of EBIT EPS analysis. So this is brief about leverage, types of leverage, method of solving leverage, total risk, and this graphical representation of EBIT and EPS values. So we'll meet with another topic in the coming class. Thank you. Please do like, share and subscribe my channel.